Hi everyone, welcome to today's video. So the year 2023 is turning out to be a really bad year for the stock market. In the last 1 year, the Indian markets have given roughly minus 6% returns. Now, be it banking stocks, be it IT stocks, be it consumer durable stock, be it any stock that you name. And I'm sure that millions and millions of retail investors would be sitting on a loss. If that is the case, do press the like button. Now, I'm going to get 1 million likes on this video. But on a more serious note, year 2023 is turning out to be a really bad year for the stock market investors. Interestingly, a prediction was done roughly 150 years back by an American farmer who said that, 2023 is going to be a bad year for the stock market. Now you'll say, okay, since when you have started believing in all these predictions? So no, this is a very interesting story. So hear me out for 1 minute. It will help you build that conviction as to why that this year is probably one of the best years to start your stock market investment journey. So let me quickly show the prediction and then I will present a complete analysis around it. So here is the chart and I would encourage you to take a look at it and observe these point A's. So this year is 1927. So this was during the Great Depression time when the markets fell quite aggressively. Then came 1945, which was the World War period. Then in 1965, 1970s time, there was high inflation problem in the US. There was Vietnam War. So a lot of bad market sentiments were there. Then in 1980s, again, the US was facing a series of inflation related problems. I had done separate videos on that. Then in 1999, all of us know that was the dot-com bubble era. So 2019 was a slight off year because the correct prediction would have been 2020. That was the COVID fall. And then more predictions are there for 2035 and 2053. So let me quickly take you through the chart and explain it. So this point A indicates the massive reason for the fall, and after this the market falls quite aggressively and the peak negative sentiment happens at this point C. So for example, if you consider 1927, then up until 1931 the markets were really bad. Then they started to go up. Similarly, if you consider the 2000 dot-com bubble, then the markets fell till what point? The markets fell all the way till 2004, 2005, and after that they started to rise. Now you might say that, okay, I do not see 2008. That should have been there. I agree. That is a miss by this model. So to cut the long story short, these predictions were done in the year 1875. So you can see it signed here. And they have been correct about a lot of events and the hit rate is just phenomenal. So comes the question that, okay, why am I speaking about this model in the year 2023? Well, again, let's go back to the model. So this is year 2023 and you can see that the investment sentiment is at the lowest. So if you build positions in this year or maybe even the next year, and if there is sustained bull run after that, then as per the model, the next major crisis is going to happen in 2035. So you are likely to benefit a lot. So now you might have another question that, okay, can you explain how this model was built and why is it so accurate and do you believe in it? So let me quickly comment on that and then I will explain you a more refined model that you can use in the year 2023 to make stock investments, and then I will discuss some specific stocks. So okay, so going into the background of the model, this model was developed by a person called as Samuel Banner. So Samuel Banner was a farmer back in the US and his entire livelihood depended on doing weather forecasting and whether the crop will be good or bad, when rain will happen, vagera vagera. So he started observing the prices of different crops. So based on that, he tried to predict the solar cycles and a bunch of weather forecasting around it. And he reached an eventual conclusion that roughly every 11 years, there is likely to be a major fall. And therefore, it is said, even in the stock market, that the stock market falls once, quite aggressively every 10 to 12 years. So this model kind of supports that hypothesis. So it's not as if that some random person came up and they just willy-nilly painted a picture and stamped it and the model has been working great. No, so there was a little bit of science that was going behind it, no doubt about that. So this brings me to the second part, that do I actually agree with this commodity driven model in the year 2023? The short answer is no. And this reminds me of the story of an octopus called as Paul the Octopus. People who love football would know about Paul the Octopus. He was a very famous octopus who used to predict the next winner of the World Cup. And this is how he used to do it. So it's a fascinating story. And if you look at the hit rate with the accuracy with which Paul the Octopus predicted the football World Cup winners, it came out to be whopping 86%. So yes, of course, he was wrong once in a while, but majority of his model was right. But if you ask me that, okay, can I prove the science behind or give some logical explanation how an octopus was able to predict World Cup winners, I would not have an answer. But here, when it comes to Banner model, Is that backed by science? So the short answer is yes, but it is not completely backed by economics. And that is the explanation that I'm going to present now, that what economic angle is missing from it. And if you include that, then can you come up with a better prediction model? So there are three specific points that you need to know. So first and foremost, the model, as I previously explained, was based on commodity prices. Now these were prices of food grains. This was prices of metals around it. So back in the day, especially pre-1990s, there was less usage of internet technology and there was much more contribution of agriculture to the entire GDP. So this model fairly correlated, so to say, with the economic outcomes. So let me show you this chart, and this comes from World Bank data, and you will categorically see that right from the year 1970 all the way up until now, the contribution or percentage contribution of GDP from agriculture and fisheries has been on a constant decline. And more the contribution of agriculture shrinks, the more noise this model is going to create and less accurate it will be. The second key point that you need to know in order to refine this model is that the contribution of tech has massively grown since the year 2000, right? So if you consider internet-based companies, they started gaining more prominence after the year 2000, once the dot-com bubble burst was over. 2008 was also a pivotal year in the history of money, and I'll explain it in point 3. But the second point that we need to understand very clearly is that the contribution of tech over time has been increasing, and the last 2.5 decades have been a game changer in defining how the businesses are built. Consider, for example, the acquisition of Instagram. Instagram was acquired in the year 2012 for $1 billion. And back in the day, if you go and read the newspapers or online articles, you will categorically see that people were criticizing Mark Zuckerberg like anything. That, you know what, why would you pay like $1 billion for a 13-member team company? And Instagram right now is one of the major money maker for the parent group company, which is now called as Meta. Now going forward, it is very, very likely that with the artificial intelligence, chat GPT type of tools, machine learning tools, DeFi tools, what is going to happen is that more and more contribution of tech to GDP will happen, and lesser the percentage of agriculture to the GDP growth will be attained. So this brings me to the third part and the story as to why that previous model could not capture the 2008 crisis. The reason was very simple, that after the dot-com bubble burst, the governments all across the globe, they started thinking of creative ways of dealing with troubles. 2008 was that watershed moment when the governments had no other option but to start the race for money printing. And 2008 was that pivotal year when money in a way became fake. Now, what do I mean that money became fake? In order to understand that, you need to understand the concept of M1 money. Now, M1 money in very simple, easy to understand language means that this is the free float of the money that is available, which is highly liquid. Now, let me show you two graphics and you tell me whether you think that there is something off here or not. So this is the supply of M1 money in India, and you can categorically see that this used to be the trend line for M1 money. Then it changed, and then it almost became exponential. So this is trend line 1, this is trend line 2, this is trend line 3. Now let me show you another funny picture, which is the same data but for the US market. So here you can see that this is trend line and then it almost went exponential. Now anything, be it a stock price, if it is going exponential in this literal way, then the chances are that it is going to fall quite aggressively. And that is precisely what is likely to happen next as per my understanding of economics. So in 2023, from a market point of view, as things stand, what is likely to happen going forward, and then I will start discussing specific stocks. What is likely to happen is one major macroeconomic change, and that is the division between the rich and poor. So far, our society can be somewhat divided into three spheres. One would be rich, ultra rich category. Second would be poor, and in the middle, you have a middle class. I have made enough videos on the same topic where I have categorically come out and said that, you know what, going forward, the world is going to get divided in literally two. One would be ultra elite rich, the other would be poor. The fraction in group A, ultra elite rich and rich people, they are going to be a fraction, and majority of the people living in the world will fall in that lower category. So the big middle class that we keep talking about, that, you know what, there will be migration of middle class to rich class. Well, more migration is going to happen from middle class to poorer class. Why is that the case? Again, I'll make some kind of an updated video on that. But the reason why I'm saying that, and it can be seen from the way the companies are functioning now, you would have seen that in the year 2022, Mercedes did record number of sales in India. Lamborghini was sold out. Real estate projects have been sold out, vagera vagera. So these are hyper rich class people and they are only getting richer with time. On the flip side, if you consider the average income in India right now, it comes out to be 24 to 25,000 rupees. And you tell me that if you are making 25,000 rupees, would you consider yourself to be middle class or would you consider to be in that poorer segment? So like it or not, our world is getting divided into these two segments. It's a very important demographic change that we need to understand. Why is that the case? Because it is going to shape up our investment decisions. So this brings me to the third and final part of this video where I will start speaking about specific stocks and what type of stocks I'm looking to purchase versus avoid. If you have liked this video so far, humble request that please press the like button. It would allow these type of videos reach out to more people. I'm relating economics, I'm relating sociology, I'm relating psychology, history, and factoring it into stock market. Second key point, I give a lot of advanced level stock market commentary as to what I'm buying, what I'm selling, why, economics, finance, history behind it, and I explain it via a community post. So in case you want to learn more fundamentally about the stock market, you can definitely check that community out. The link is given in the description and comment box. So these are 5 investment options I'll quickly give you clarity on. So the first investment type would be startups. So these would be companies that are looking to do their IPOs. A bunch of them had already come out with their IPOs in the last couple of years. And now they are down by 60, 70%. Now, to cut the long story short, what is going to happen in the world going forward is that I showed you that M1 money supply, that is going to come down and it is going to create a lot of pain for debt-oriented businesses. Now, what are debt-oriented businesses? So for this, you need to study the VC or venture capital model. If you pick up the case study of Oyo, Ola, bunch of other startups that have boomed and so many unicorns have been created, they have all been funded by VC money. Now, how do VCs get money? Now, VCs get money from LPs. Now, LPs are another type of investors who are giving and funding money to VCs, and VCs further pick that money and give it to startups. So this entire ecosystem is somewhat drying up. It has become evidently clear that even VCs want their portfolio companies like Ola, Uber, this, that to become profitable, not just simply run after revenues. Last 2 years were a great fit, so to say, that you know what, that a lot of new age startups were able to IPO. But going forward, unprofitable startups looking to do IPOs, that will become really tough. Now you'll say, yaar, ye to obvious hi baat hai. Even I know it. What is it that you're telling me? I have learned my lesson. I burnt my money in like bunch of these new age startups. So I'm not going to invest. See, this is where the story gets complicated because if you study the business model of Mamaearth, Byju's, they have all come out with their explanation and prospectus and are about to IPO. So please study the financials properly. Please study the business model properly. With 1-2 years of profitability that has somewhat been crafted, please don't run after that. Study the business model fundamentally. This is where I'll stop on the first investment side, that generally avoid these type of investments. Second, what type of investments am I making? So I'm trying to make investments that give me inflation protection. Why is this the case? The reason is very simple, that the inflation in the world will remain high. That is not coming down. The interest rates might be brought down, then they might be increased again, then they might be brought down again. All that drama will keep on happening. But we have moved to a world where inflation will remain high. Why is that the case? Again, going back to that increased money supply or M1 money supply, that needs to be brought down. When the money supply is really, really high, the inflation will stay high. So we are definitely looking at a period of 10 years of very, very high inflation, and the type of stocks that are likely to survive are the ones that have a pricing power. So let me give you 2 examples there. One is Hindustan Unilever. That's a company that can keep on increasing its price, but people will still buy the product. How do I know it? Again, please go and check the last 2 year data and look at the price increases that HUL products have undergone. Second example here would be something like Apple, that it is able to increase its prices at its will and people still continue to buy Apple products. So these type of companies are going to do well over the next 10 years and I'm aggregating as much as possible. The third key type are the tech stocks. So if you can find really good tech stocks, you can directly build position. That's a second, the market is overall down. So if you do not know about tech stocks and if you just generally want to widen your bet, then you can definitely consider something like ITBs. rupees. So this way you are betting on the entire IT market in India. Similarly, you can simply go and buy Nasdaq in the US. Again, that becomes a viable option. Then comes the third investable option, which according to me are companies like Pidilite, for example, which have some kind of manufacturing moat. So what is the meaning of manufacturing moat? In very easy to understand terms, for example, if I try to compete with Pidilite, and if I'm setting up my own manufacturing factory, vagera, I am able to produce one Fevicol at 100 rupees or one adhesive under my brand at 100 rupees. But Pidilite, since it has that supply chain, has that branding power, all that stuff going for it, it will be able to produce that same unit at 80 rupees. Same goes for something like Asian Paints, that there is no reason why Asian Paints will be producing a bucket of paint at a higher price compared to any other paint or home decor firm. So these two become your investable option. Then come fifth and finally, that if you do not know much and if you want to build position in the Indian market, then Indian banks are very, very good. They have stood the test of time, so to say. One of the prime reason was that a lot of bank cleanup had already happened. So which specific banks to buy, which specific banks we should not buy, this is the precise commentary I'm going to give on tomorrow's member post community. But I hope that you will keep these salient points in mind and act accordingly. Now, one very important note, let's see, if you're buying banks, if you're buying tech stocks, if you're buying IT companies, and if they fall tomorrow, please do not panic. One of the central principles of making money in the stock market is that you have to be patient. Right now, everything is falling or it is at best staying sideways. Now, unless the entire market gives a breakout, all these stocks, whether they are good, whether they are bad, they are going to move sideways or downwards only. So please remember that. Please do not start panic selling it that, you know what, I bought like Asian Paints or I bought like this good company, fundamentals are good, everything is good, but the stock is not moving. Stock will only move when the sentiments are back. So please remember that and curate your strategies accordingly. I hope you enjoyed the video. If you did, press the like button and I will see you very soon.